So in this section we will be discussing about IAS 8, that is okay guys, so in this section we will be discussing about IAS 8. So IAS 8 is basically a important standard, but it is not getting tested individually in a question. Of course it can come in the discussion part, as well as it is applied in almost every accounting standard. Okay, so IAS 8 discusses about the accounting policies. What do you mean by accounting policies? As well as whenever there is a change in accounting policy, accounting estimates, or when you are finding out errors in some of your previous year financial statement, how will you account it? So that's what we are going. How will you manage that situation? That's what we are going to discuss here in this part. So first of all we will discuss what are accounting policies. So the accounting policies are basically principles, basis, convention, rules or practices which we will follow. Accounting principles are basic, like these are basically principle, basis, convention, rules and practices which will follow. That are applied in preparing and presenting the financial statement. So it can be certain principles or certain conventions that we follow. This all can come as a part of your accounting policies. Okay. So whenever we are applying these accounting policies, we should make sure that we should apply the relevant and the appropriate interpretation. Suppose if there is no particular accounting standard is found out for treating a particular transaction, and develop and apply a policy resulting in a formation that should be relevant and reliable and represent faithfully and reflect the economic substance and neutral, should be prudent and compete in all material aspects. So what do you mean by it? Suppose if you don't have a specific accounting standard, let's say currently we don't have a separate standard for applying for accounting for cryptocurrency. Okay, so depends upon the situation in which the way we are using that cryptocurrency, whether we are using it as a funding or whether you are trading it, whether you are getting the revenues in the form of cryptocurrency. On the type of transaction we will be using different accounting policies. So when a particular standard is not developed to interpret a situation, we will be using the accounting policies. Okay, and whenever you are using such accounting policies to analyze a particular transaction, we should make sure that the decision that you take should be relevant and reliable, and it should be represented faithfully, and it should reflect the economic substance of that actual transaction, and the decision you take should be neutral and it should be prudent. So what do you mean by prudent? So prudent means that the asset should not be overstated or liability should not be understated, and it should be complete in all material aspect. Okay, we should disclose each and every information which is regarding to that particular information, or with this regarding to that particular accounting standard. Then one of the example we can just see that here a company has valued FIFO in 2009, FIFO basis. So in 2009 it decided to switch to weighted average valuation. So earlier where they were following FIFO, now they have shifted to weighted average. So weighted average cost model to value the inventory. Okay, so the gross profit in 2008, the financial statements was calculated as follows. So that is revenue, the cost of sales, everything is calculated. So in order to prepare figures for comparative figures for 2008 showing the change of accounting policy, it is necessary to recalculate the amounts of 2007 so that the opening inventory for 2008 is valued as per weighted average basis. So here we have seen that there is a change happening to accounting policy, that is they are moving from FIFO to AFCO. So whenever there is a change in policy, whenever there is a change in accounting policy, we should make those changes retrospectively. Retrospectively means not only from the date of change to future, we should also change the comparative figures in the past. Okay. So as they have told there, so if you have to make the from 2000X9 we will be using AFCO. So we have to make the comparative figures to be changed from 2000X8. But since it is inventory, we know that inventory is calculated like opening plus purchase minus closing. So this opening of 2000X8 will be the carry forward balance of 2000X7. So even that should be restated. Then only you will get the appropriate comparative figures, right? So it is established that the opening inventory of 20X8 based on the weighted average method would be 12,200 and closing inventory will be 143,000. So we'll change that. So whatever the extract they have given with regards to 20X8, we will change those extract. So we will change the opening inventory as well as the closing inventory. Valuation should be changed so that the new profit is how much? 644. So which is lower than FIFO. So when we are following FIFO, our profit was how much? 662. So as a result of this change in the method, we have restated the figures, we have restated the comparative figures. That is, this is from 20X7 and this is of the figure 20X8. So they have changed this comparative figures and they are calculating a new profit. So this is 18,000 lower gross profit for 20X8, which will reduce the net profit and retained earnings by same amount. It will reduce the net profit and retained earnings by the same amount. The opening inventory of 20X9 will be how much? 143 rather than 174. And the statement of changes in equity will show an 18,000 adjustment to opening retained earnings. So where will you adjust it? Where will you make this adjustment? Let's say when we prepare statement of changes in equity, we will have the opening balance, that is opening share capital, then share premium, the retained earnings, as well as other components of equity. So this is the opening balance. So in that, after writing the opening balance, we'll write an item called, we'll write an adjustment here, that is whatever the reduction happened here, we will adjust it to retained earnings. Whatever the adjustment we have to do here, we will adjust it to the retained earnings. So we know that as a result of this change, the gross profit of last year had reduced by 18,000. So before, how will you change it in the statement of changes to equity of 20X9? So in the statement of changes to equity of 20X9, when we prepare that changes, when we prepare that FS to the retained earnings column, we will reduce 18,000. So by doing so, we are making sure that we made the changes retrospectively. So whenever there is a change in accounting policy, we have to make the changes retrospectively. So this is how we'll make the changes retrospectively. Is it clear, everyone? Perfect. So consistency. So what's the reason for this? The selection and application of accounting policy to transaction of a similar nature must be consistent. That is, IAS 2 inventories, the same cost formula must be applied to similar items. The different cost formula can be applied to a different classification. So one of the peculiarities, like if you are choosing cost model, then this cost model should be applied for all class of assets. The whole class of assets, the whole class of assets should be following the cost model. Okay. Then change in accounting policy. So what are the situations in which we can actually change the accounting policy? We can only change it if it is required by statute, that is by law, or as required by IFRS or IAS, or if it is presenting a better and more relevant and reliable information. If we are able to convince the auditor that by doing so, by changing this accounting policy, the way it is going to get presented in the financial statement, it will give a more better and reliable information. In that scenario, we can change the accounting policy. So these are the three situations in which we can change the accounting policy. First one, it is as required to do so by the statute. Then if it is required to do so by IFRS or IAS, as well as if it is resulting in a more relevant and reliable information. Okay, example is when change is happening from cost model to revaluation model. When there is change from cost model to revaluation model, then we can consider it as a change in, if there is then we can consider it as a change in accounting policy. Okay. So whenever there is change in accounting policy, we have to make certain provisions. So if no transitional provisions, so whenever there is a change in accounting policy, we should check whether there is transitional provision. Transitional provision means, let's say, when we have moved to IFRS 16 from IAS 17, how the company should adopt the changes, how we have to make the changes to those accounts which we have prepared early using IAS 17. That guidance was written there in the standard. That how to make those changes. That guidance was written in the IFRS 16 standard. So that is known as transitional provision. That by law they will say how to make the changes. So if there is no transitional provision on a voluntary changes, then must apply retrospectively. So how will you make the changes retrospectively? Adjust the opening balance and the equity for the earliest period presented, and the comparative preferred figures or the amount disclosed for each prior period as if new policy had been applied. So like what you have seen in the last example. So there we have restated the opening balance and closing balance, even though it was accounted as per first in first out method last year. Since we are adopting a new policy, as a result we are making those changes in our last year's FS as well, right? So that's the reason, that's what we can say as the retrospective adjustment. That is known as the retrospective adjustment. Clear? Perfect. Then in the same way, when there is a change in accounting estimate, in the same way if there is a change in accounting estimate, an adjustment to the carrying value of an asset or liability arising from the current assessment of the expected future benefits or obligation. So if there is an adjustment to the carrying value of an asset or a liability arising from the current assessment of expected future benefits or obligation. Like what I've said, if there is a change in the useful life, or if there is a change in the residual value, these all are considered, or change in the value of provision, these all are considered to be a change in accounting estimate. It arises due to new information or new development. So example, a debt that become irrevocable or change in useful of life of an asset, this all are considered to be accounting estimate. So these are our estimates. So estimates can go wrong. So as per this standard, some other examples are loss allowance for bad debt and doubtful debt, NRV of inventory, many provisions, allowance for depreciation, right? This all considered to be a part of accounting estimate. So the effect is recognized prospectively. So instead of making the changes in the last year's figures, here the effect is made prospectively, that is included in the current and future period P&L. So that will get adjusted to the current period FS, as well as this impact can have on the future period as well. So we have to make the changes from this date of change to the future. That's how we have to treat the change in accounting estimate. This is how we should make the changes in accounting estimate. So if the measurement of assets or liabilities is affected, then we have to adjust the carrying amount. Let's say in the case of an asset, or in the case of PPE or something like that, as a result of the change in the useful life or the residual value, there will be changes to depreciation methods as well as depreciation assumptions. So it can make some changes to the carrying value of the assets. So we have to make those changes. The other side, diable entry is to be made in the statement of comprehensive income in the period in which the estimate is changed. So as a result of this change in the estimate, if there is a change in the, if there is an increase in the expense or decrease in the income or something like that, we should account it immediately in the statement of comprehensive income. Then finally, in IAS 8, we will be discussing about the mathematical mistakes or especially the errors. So what are the errors? The prior period errors can be mathematical mistakes or mistakes in accounting policy. Because if you are wrongly applying a standard to a transaction, then misinterpretation of fact, then fraud, any kind of oversights, okay, any kind of wrong assumptions, this all can comes as a part of your prior period error. So if there is a prior period error, we have to make sure that we will make the changes retrospectively, because we can't say that okay, let the error there should be there in the FS, we don't need to consider it, let go on with the current FS. We can't do that because this is an error. Of course, we have to make sure that we will make the appropriate changes to this error, then only we will move forward, right? So whenever there is a prior period error, it is very important for an accountant that he should make the changes retrospectively, not prospectively, retrospectively. He will go back and will make sure that he will make the changes there. So the material errors are corrected retrospectively in the first set of financial statement authorized for issue after their discovery. So restate the comparative information for the prior periods presented in the error which occurred. So if the error occurred before the earliest prior period presented, restate that prior period's opening balance. So as you have seen in the case of that inventory example, if there is an error, we should restate it in the last year's FS. We can do it by making the changes in your opening balance as well. The retrospective restatement is limited to the earliest practicable date. We can't make the changes in the last 10 years or something like that. So there is a limit to make the retrospective change. So we should, it is limited to the earliest practicable date. So let's see here the statement of profit and loss of TUSRA X7 with TUSRA X6, the comparative and the retainings are given. So during X7, the global discovered that certain items had included in the inventory at 31st December TUSRA X6. It is valued at 4.2 million, which had in fact been sold before the year end. It has been in fact been sold before the year end. Okay. The following figures for TUSRA X6 and TUSRA X7 drafts are given here. The retainings of 1st January TUSRA X6 is 13 million. The cost of goods sold of TUSRA X7 is 4.2 million. It is an error in the opening inventory. Actually, it's an error in the opening inventory. The income tax rate was 30% and no difference has been paid. So what is the error? The cost of goods sold includes 4.2 million error in the opening inventory. So we have to correct this error. So this error happened because of TUSRA X6, right? So the cost of goods sold as given in the question is 3457. 0, it's the cost of goods sold which is given in the question. So by using that figure, we have to make the changes. So 3457, to that we have wrongly included, right? So we should add it back to the inventory of TUSRA X6, that is 38770, and we'll deduct it from our current year's opening balance. So as stated in the question, what is the value? 55,800. So we should reduce this 4,200 here and we'll add it back here. So these are the restated figures. So we'll be using these figures to calculate the profits now. As well as income tax of the last year, it is 3880. So now we have to recalculate it as stated in the question. So 3880 into 30%, but it should be after deducting for the tax. So result of the inventory adjustment. So here we are adjusting for 200, right? We are including it. So when we are including it, there will be tax paid. So to 3880 that was your opening inventory balance. 3880 is the income tax. Opening, as per the question, this is the income tax. So to that we will adjust this 1260. 1260 will be the error, that is 4200 into 30%. So when we include this inventory, we have to pay tax. So 1260 will get included here and will get added back in the next year. So this is how we'll make the changes retrospectively if there is a change in the accounting. Sorry, if there is a prior period error. If there is prior period error, we should make the changes retrospectively at the earliest possible date. So here again I will explain, the inventory was wrongly included 4,200,000 in the opening inventory of 2086. So we will deduct it from the opening inventory. 55,800 will get deducted and will get added to the last year's closing entry, that is 34570. To it we will add back this 4200. Okay, then finally you will get the new cost of goods sold, and when you get the new cost of goods sold, one more thing you have to do is this, whatever the inventory which you have included to 2086, as a result our 2086 tax will go up, as well as that's why it is the deduction here, as well as in the second year the tax will increase. Along with the 3400, this tax will increase because the overall cost of goods sold is going down. So earlier it was how much? It was 11,400. The total profit was 11,400 and the cost of goods sold was 55,800. So now it is how much? 51,600. So if the earlier it was 58, now it is 51. As a result, the profit will have been increased, would have been increased. So that's the reason this amount is adding as a tax. It is increasing my tax expense. And here the overall cost of goods sold is going down. Okay. So as a result, the profit will go down. Right, the profit will go down because of the higher cost of capital or the highest cost of sales. So finally this particular closing balance will be 2620. So this is how we should account for IAS 8 in your accounting policies. This is how we should account for IAS 8. There is changes in accounting policy errors and as well as prior period error. So if there is prior period error, we have to make the changes retrospectively at the earliest date possible. If there is change in accounting estimate, we only need to make the changes from the date of change prospectively. If there is changes in the accounting policy, we have to make the changes overall. That overall policy needs to be made retrospectively. In the case of accounting estimate, we just need to make the changes prospectively. In the case of accounting policy as well as this particular errors, prior period errors, we have to make the changes retrospectively. Only for accounting estimate, we will make the changes prospectively because it's estimate, so of course it can go wrong. Is it clear, everyone? So what you have to learn here is something very basic. So whether it's accounting policy or accounting estimate, you need to identify that. And finally you have to give a comment. If it is IAS 8 change in accounting policy, then we have to consider the changes retrospectively. If I ask for IAS 8, if it's a change in accounting estimate, then we have to consider the changes prospectively. So clear, everyone? Okay, so that's it for IAS 8. That's it for IAS 8, that is changes in accounting policy, estimates and errors. Okay.